I think this coming Wednesday, Becky, will really answer a lot of questions because I think you've summed it up well. Investors have been grappling with this idea that can the Fed be in a position to, you know, reduce real rates if we've got good economic growth? Because what does that mean for inflation? And this coming Wednesday is March CPI. I think it's going to be the first clean CPI report of this year. You know, it won't have any residual seasonality. We're expecting that to be a pretty good report, lower than expected inflation. And I think it's going to help investors get to this place where we can have pretty good growth in the economy. There's some slack in the labor markets, but inflation's falling fast enough for the Fed to actually cut rates this year. And of course, that'd be great for stocks.
I know you'd been telling people kind of buy on the dip, not that there's been much of a dip if you're just talking about a pullback of a few percent. Does it matter if the Fed cuts rates or not? If the economy is really strong anyway, will earnings be able to justify the valuations at this point?
I think the Fed being supportive of the economy, so managing the business cycle, is the most important thing. In the last 2 years, the Fed was fighting inflation and therefore hawkish. That was tough for equities. But if we're in a mode where the Fed doesn't know how many cuts it needs to make, but it actually wants to support the business cycle, that's good for stocks. So I don't think you need to have 3 rate cuts. You could even have a good scenario where the Fed only cuts once. But if the Fed's in a position where they feel they need to actually raise interest rates, that'd be bad for stocks. I think Jamie's doing his shareholders justice because they want to hear from him about all the concerns out there. I think he does a great job of detailing all the things that could go wrong. But at the end of the day, when it comes to markets, I think markets tend to price concerns very quickly. I mean, I think that's really been the concern for the last 2 years is a hard landing. And now that inflationary pressures are easing at a time when consumers don't have a lot of leverage, there's all this, there's $6 trillion of cash on the sidelines. And inflation, we don't really know how quickly it's going to fall, but our bet at Fundstrat is that it's going to fall pretty quickly, means some of the concerns he listed about a hard landing are because of sticky inflation. And if it's softer, I think we're going to have quite a good economy.
Is this a two-pronged outlook on the economy and the markets, though, Tom? Is inflation the one big issue? And if Wednesday proves that it's a hotter than anticipated or hotter than expected CPI number, would you change your ideas about what that means for both of those things for the long term or for the year?
That's right. I think if inflation, because March is going to be the first clean CPI report. We know out of Europe, they've come in pretty soft. They've come in better than expected. If it comes in higher than expected, then I think it raises the question that the inflation is quite stubborn and getting to that from 3 to 2 is going to be difficult. On the other hand, if it is a soft report and we think it's the probabilities favor below a 0.3, that's consensus core 0.3, I think it's going to change a lot of people's minds that inflation may not be that stubborn.
Yeah. You have been telling people to buy, or you yourself have been buying on any dips. And by dips, we're not talking 5 or 10% drops. You're talking 2% drops, and you'd be buying into the market?
That's right. I think that there's many reasons that we still think there's gas in the tank in this rally. Part of it is that we do think the inflation trajectory is on a glide path lower than consensus expects. The second is I think there's too much caution out there. When you look at prime brokerage borrowings or basically leverage in the market, it's still below where it was in October 2021. There's still $6 trillion of cash on the sidelines. In our conversations with clients, they're still quite cautious. So as long as investors are top calling and are really looking at the world half empty, I think stocks can still rise on this wall of worry.